Today, trade surprises on the upside. Hello again, it's Martin North from Digital Finance Analytics, working with latest posts covering finance and prop news with a distinctively Australian flavour. The ABS has released their trade data for November 2019, and superficially at least, it looks reasonably strong. They said that in trend terms, the balance of goods and services was a surplus of $5.3 billion in November. That's a decrease of $455 million on the surplus in October 2019. But in seasonally adjusted terms, the balance of goods and services was a surplus of $5.8 billion in November, and that's an increase of $1.725 million on the surplus in October. And of course, all the commentators then leapt on the bandwagon, looking at the seasonally adjusted data, to say that things were looking up, and it was a surprise on the upside, and it was all pretty good. However, I'm afraid that I continue to look at the trend data because I think the trend data gives us a better feel for what's really going on. So today I just want to touch on a few of the dimensions around the trend data and highlight the point that actually things are not as positive as those commentators might suggest. So let's start by looking at the trade balance. And this particular chart is showing both the seasonally adjusted and the trends over the last few years. And you can see that the seasonal numbers are moving up and down quite wildly. But the trend of $5.39 billion is looking a little bit more even. And that's my point really, because last month there was a significant fall in the seasonally adjusted numbers and a significant rise this month. So that's why I tend to look at the trend. And certainly you can see that compared with 2015 and 16, where we had a deficit, the trade balance is still very strong. But I think it's also true to say that the trend is downward. Indeed, it's now below $6 billion. Now, to understand what's going on, we should look at the trade balance in a little bit more detail. So firstly, that's the same picture again, just slightly more stylized. And then we can look at exports, and we can see how the value of exports has run up significantly. It reached a peak back in June, slid a little bit, and has moved slightly higher. Now, some of that is to do with the higher iron ore price, and we'll touch on that in more detail in a second. On the other hand, the imports are relatively flat, and that is a reflection of slow local demand as businesses are investing less in the future of their businesses and households are consuming less. And in fact, it's the slowing of imports related to the slowing economy which is really driving the numbers at the moment. Now, I also just want to highlight the fact that if you look at our exports, there are a few important standouts. The most significant is metal ores and minerals, and of course that is iron ore. And we can see that those values have actually slid a little. It's still above $10 billion a month. And that's been supported by a much higher iron ore price than everybody expected. It's sitting at around $95 at the moment. So demand is still quite high, but actually it is sliding a little. And the same is true of coal, coke and briquettes. And that's a little over $4 billion a month, but is continuing to move down. And that's partly because of lower levels of demand and partly the change in prices. However, other mineral fuels, which includes LNG, is rising a little and in fact has now become more significant in trend terms than coal. There are also other metals, and that includes lithium and other rare earths, but that is a much smaller proportion of our total export contribution. And another line item relates to other manufacturers. And finally, gold, because we are exporting more gold than previously, so that's risen higher, and of course the gold price has also increased as well. So you can see in a way how unbalanced our economy is and how significant iron ore and coal and LNG are. And if you then reflect on the discussions around climate change, you can see that those three commodities, which of course are very carbon intensive, are really the foundation of our economy. So if you were to turn those off tomorrow, we would have a significant issue. Hence the dilemma around climate change. And I will just also highlight some of the agricultural issues too. So for example, we see that meat and meat preparations are rising. It's 1.5 billion now in November. And that's partly because of the increased demand from China and elsewhere. But of course, it's a very small quantum relative to the big numbers we saw on the previous chart. On the other hand, cereals and cereal preparations has declined from 2016 and 17, and that's partly a reflection of the drought. Wool and sheepskins are also lower. And of course, it used to be the case that Australia's economy was riding on the back of the sheep, but really no longer. And finally, there is a category of other rural goods, which includes a wide range of different products. But again, it shows how much pressure the economy is on. And remember, of course, that the bushfires will be impacting the agricultural sector ahead. So whilst all the discussion from the analysts will be on the upside based on these seasonally adjusted numbers, I think the truth lies elsewhere. And we are very trade exposed, partly because of the commodity base that we are using, but also because of the very high prices, which are unrealistically high at the moment and probably unsustainable. And as I spoke about the other day, in my EFO, there is an assumption that in the future, commodity prices will be lower. And they made the point that a $10 shift down in the iron ore price would translate to more than $3 billion impact to the bottom line. This is why I believe that we need to find a different economic platform for the future of Australia, which is broader and more innovative, rather than continuing to work on those old industries, which do have a future, of course, for some time, but ultimately will have to be replaced by greener, more carbon neutral alternatives. That is the true economic reality, at least as I see it. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.